This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. I am joined, as always, by my energetic co-host, Mr. Mark Yusko. What's going on, Mark?
Energetic it is, and just to prove that, I'm going to jump up on the stool, do the sock reveal right away. I have the orange pants on because I later today am doing a podcast with the originator of the orange pants, Adam Draper.
Nice.
But today I have the, Bitcoin on ice. The cold storage. I've used them in the past for crypto winter. And yes, we are still in crypto winter and it's going to be with us for a while. But today it's really about the fact that a lot of Bitcoin are coming off exchange and going in cold storage. And the other piece about that is if you don't have some of that, you need to. What's going on in the world today is nothing short of crazy with the fiat system. Just look at the yen. Since we were together last week, it's just gone ballistic again, and some bad stuff is coming down the pike. So you need to have a little bit, not a lot. You need to have a little bit on a ledger, on a treasure, somewhere that is your running money. So.
Yeah. What do you think about the whole Bitcoin moving on and off exchange thing, right? Because there's that whole, there's accumulation, there's selling, and but I mean, there's a whole element of that, which is just collateral management as well. I feel like it's a bit of an overused metric.
100%. In the early days, it was a great metric.
Yeah.
Today, to your point, it's not very useful at all. I think most of the on-chain stuff that people tout is outlived its useful life. And it's because as markets mature, to your point, other products now get involved, and there's collateral. There was the story this morning about the guy who took a loan out against his Bitcoin to buy his mom a house, and that kind of stuff is going to happen. And it reminds me, I was growing up in the business. There were no computers, and then we all got computers, and then there was this big thing about earnings estimates. And if you could get earnings estimates before everyone else, you'd have an edge. And so Zacks, this company, came out and created earnings estimates, and they accumulated all the estimates from around, and they posted it. And for a while, it was actually pretty useful. And if you subscribed to them, but then everyone could get the earnings estimates right from everybody. Well, then it moved to the whisper number. So you couldn't actually have the estimate. You had to have what they really thought. So the insider stuff. But in the end, once an indicator, it was like stock to flow. Look, I love the construct of stock to flow. But once everyone was using the same model, the model becomes less useful. That's true of any model.
Yeah, I think it's just a sign that the market is getting more complex and maturing in general, right? So a lot of stuff that worked at the beginning is just not going to work anymore. I've got a lot of kind of macro stories to get into today. I actually want to start, I want to jump out of order a little bit. I'm going to share my screen here because we were just getting into this before. We got to talk about Bill Hwang. So this is actually, the title of this slide is, what was Bill Hwang thinking? And this is the title of a Matt Levine piece that he wrote. I mean, first of all, nobody does it like Matt Levine. But for those of you who, just a little refresher, Bill Hwang, he was an early disciple of Julian Robertson. He ran this fund, Archegos, right, which famously got Credit Suisse into a lot of trouble, right, with just this unbelievable amount of risk they were taking. It's got to be about a year ago. Yeah. Okay. March of 2021. Look at some of these statistics. Are absolutely wild. He's now being charged with market manipulation, a felony offense. For example, listen to some of these stats. For example, by late March of 2021, Archegos' cumulative cash equity and derivative SBS exposure to the following issuers equated to the following percentage of outstanding shares. GSX, over 70% of outstanding shares. Discovery Class A, 60% of outstanding shares. IQ, IUI, over 50% of outstanding shares. And then look at the exposure that they were taking as well. As of January 1st, 2021, Archegos had approximately $7.7 billion in invested capital on gross exposures of $54 billion. And as of March of 2021, Archegos had over $36 billion in invested capital on over $160 billion in gross exposures. Now, I'm like, these numbers just absolutely blow my mind. I mean, Mark, what do you think about this?
Look, they really blow the mind when you go back to the fact that when I was at University of North Carolina, we gave Bill his 6 and 7 millionth dollar. Julian, the first 2 Tiger seeds. So everybody's familiar with Tiger Cubs, people that worked for Julian, then left, set up their own shop. But then there was this phenomenon where, Bill and Chase had basically worked for Julian for a few months. They came in late in '99. The shop shut down in first quarter 20, and he felt guilty. And so he said, I'll give these guys some money, and called me up. I was at the University of North Carolina. He said, hey, you guys have an emerging manager program, right? I'm like, yeah. He says, I'd like you to give these fine young men a couple $1 million. I'm like, yes, sir. And so Tiger Asia was born, and they did extraordinarily well. But then they got caught a little bit with some funny business around swaps. And I actually try to live by, I have a less nice word. We'll call it the no jerk rule, right? Use another term for a male bodily part. But anytime somebody does something, even, and I should wait till people are convicted, right? But where there's smoke, there's fire. So we moved on. Turned out, right, Bill did get accused and basically said, if you ever land in Hong Kong, we will arrest you. So he never went to Hong Kong, so he never got arrested. But he did then convert to a family office. And for those who don't know, if you publicly announce that you are converting to a family office, it means you have violated securities laws, right? That is the code. And there are a lot of big famous people who have converted to family office. And if you've watched the show Billions, you understand exactly what I'm talking about. And it is code for, I was flying too close to the sun. The SEC said, I can not go to jail, but I can't take outside money anymore. And so you turn into a family office. But what he does is really, really profitable for the brokerage firms. And so they extend this credit. And, it's unfortunately a very common tale, not super common, but more common than you think, where people accumulate very large positions of illiquid companies and pump the stock up. They clip incentive fees, and then they feed the ducks. And there's a whole bunch of people from the Fidelity foursome that got kicked out for doing that back in the 90s, to a bunch of hedge fund guys. So it's a sad tale. And then the part that you and I were talking about that I think is funny is, Bill went to a lot of effort, and other people too, to defend him on character. And he was always a nice person to me when I knew him, but he went out of his way to talk about how religious he was and how he had these foundations that gave away all this money to religious purposes. And it just reminds me of that Shakespeare quote, right? The lady doth protest too much, methinks. When you have to tell everyone how good you are, that's what you were saying earlier, then maybe it's not so true, right? Just be good, act good, but don't tell me how good you are.
It's one of those things I just kind of start to notice, like over and over. It's, sometimes these people who are extremely concerned about like PR and their public image and doing things that they know are very popular or will win them a lot of points. Mm-hmm. It's a little bit of a red flag. Not to say that people don't do things out of the goodness of their heart, and there are some people who just go out of their way to do great things. But sometimes, like it reminds me of the example that I was recently thinking of was a guy like Danny Sesta. For those of you who aren't in the crypto community, right? There's a lot of kind of sketchy behavior going on. This project that he was involved in. And he would do these things that were very popular with the community, right? If there was a hack, he would kind of refund people out of his own money, and people would take that as evidence. Oh, what a good guy. But in reality, that was kind of, maybe it was out of the goodness of his heart. Maybe it was out of an understanding that everything that was going on wasn't 100% above board, and it was almost like proactive PR management. And there are other pretty public figures that do stuff like this. And I used to view that as, wow, like what an unbelievable good guy. Now I'm just a little more cynical. Like, what's your aim here, friend?
Yeah, I mean, I said, better to just do the right thing than tell everyone how great you are, and let people decide for themselves whether you're a good person or not a person by your character. What I would say is character is how you act when you don't think anyone's paying attention. Right. And the other one is on this religious thing. It is actually a red flag for me when someone is too pious and too in your face.
I agree.
That is just because look, I'm a Catholic, and the Catholic Church is committed some terrible atrocities. I mean, like horrific atrocities in the name of God and being pious. And so this idea that can justify anything if you have faith, and it's just wrong. So, and now we have we got the other cults, right? We have religious cults that are bad. But now we have these other cults, these, the branch Covidians, the cult of science, and then we got government cults, right? I mean, there are people who are rallying around, whatever the government says. I saw this crazy stat from, Andreessen, Mark Andreessen.
Do you think he's tweeting this stuff out, by the way? Do you think Mark Andreessen, his Twitter used to be like nothing, and he used to tweet some stuff out, which was like, what? Now every tweet of his is fire. And I'm like,
it's unbelievable. And
he must have someone managing
I don't know if he hired somebody or if it really is him. I mean, he is a pretty amazingly intelligent and intellectual guy who I think could be this acerbic and this, maybe that's the wrong adjective, but this sarcastic and nuanced. I think it could be him, and he has more time because he's kind of been stepping back a little bit. He's still busy, but I love it. But he had this great chart that said, the people that trust or believe in the scientific community by political affiliation, and it's basically a third, right? Democrats, Republicans, Independents, and it kind of went up and down and up and down. But then 2 years ago, it went like this. And now it's like 65-20 Democrat, Republican. I'm like, that's a cult, right? That right there that's not thinking. That is, hey, I just absolutely believe whatever the cult figure says, and I'm just gonna not question it, not actually do my own thinking. And this is a big problem in investing, right? Is belief, and there's actually a book, I think the title is called Belief, that says most people form beliefs the wrong way, right? They are given their belief, they're told their belief, either by their parents or by the media or by some authority figure, and then they gather data to support that belief, and they reject all data that is against that belief. And of course, social media now exacerbates that problem. But the way you should do a belief, or the way you should make an investment, is you should gather the data first based on a hypothesis, evaluate the data objectively, and then make a decision, form a belief, move on. But we do it all backwards now.
That's actually something that's hardwired into humans' biology. And this was something I learned in college. So here was a pretty instructive just example that I learned that it's just influenced the way that I think people form opinions in general. If you were to see a bear in the woods, right? You're hiking in the woods, you see a bear, you would run, right? And if I asked you why you'd run, you'd be like, well, duh. I ran because I see the bear. My mind knows that that's dangerous, and then I run because I understand that it's dangerous. But that's not actually what happens at a neurological level. You've got two different sections of your brain, right? You've got like the limbic part of your brain, and then you've got the cerebral, like the cortex part of your brain. The cortex is the higher order thinking. The limbic is like the animal base instinct, emotional kind of part of your brain. That actually evolved first, and that reacts first as well, because, if you're in the wild, right, you need a very, very quick kind of emotional reaction, and then the higher order attention part of your brain, the cortex kind of kicks in. So in terms of actually what happens when you see a bear, because you evolutionarily need to react fast, the limbic emotional part of your brain registers a state of alertness. And then after that state of alertness, the higher order part of your brain starts thinking, why am I in this state of being alert? And then you attach a reason to it. And I think that that's how people form opinions in general, right? You see something, you have an emotional reaction to it, and then this part of your brain kicks in, and you start thinking, why did I have that emotional reaction? And you attach a narrative to it.
Yep.
So that's just a lot of, and I mean, that's super apparent in politics in general.
Well,
and there are all
to your
these
point, it's a rationalization of a visceral reaction.
Right.
And that visceral, emotional, physical reaction is the more pure reaction. It's like the gut versus the brain. If you think about making decisions, one of the best books I ever read about investing is probably on my shelf behind me, called The Great Boom Ahead. Not The Great Boom Ahead, I'm sorry. The Dow Jones Averages, and Dow is TAO, and it's about the merger of ancient Eastern Chinese philosophy and investing. And the foreword says, dedicated to those with the guts to trust their gut. And you have to be able to make those fast gut reactions based on your internalized kind of supercomputer, rather than getting it up here where now you'll rationalize, oh, I'm not going to sell that because, the market just doesn't know what I know. No. You're just wrong. Just move on, go to the next idea. Or, there's just so many examples of it, but you have to use that gut reaction, that now I know it's the limbic system.
It's just interesting. And they've, oftentimes too, that gut reaction, it's like people are actually really good at judging, especially other people, in a really short period of time. It's called thin slicing. And there's a really famous example in psychology, this guy, Phineas Gage. He was a railroad worker, and he had this crazy accident where like this bolt shot up through his brain, like right into his head, and he didn't die, but it changed his personality and it cut off access to parts of the limbic part of his brain. And it completely changed his personality, but B, it was kind of used as evidence that if you don't actually have access to that like emotional part of your brain, people are like, oh, if it would be better if we were robots. But actually, the emotional part of your brain is a good balance. It helps you make better decisions net a lot of the time. So it's just hard to make decisions. But the one thing I want to comment on this before we move on, market-wise, is we were talking about before we got on Carson Block, and if you look at equity markets in general, the indices are. There's a lot of pain out there in general. Like we talked about Netflix, we should talk about Amazon as well. Like their earnings came out yesterday, they're down 10%. I don't know, the market hasn't opened yet, but there's a lot of pain out there. Equity indices are finally starting to move in general. And I remember this quote from Jim Chanos a little while ago, which is that people don't care about fraud on the way up, but they sure as hell do on the way down. And I think, that just kind of makes sense, right? As prices start to go down, people start to say, why? And then a lot of this behavior that I think people cast a pretty blind eye to in this insane run-up, right, since 2020 is going to start to get investigated. So, Bill Hwang probably isn't going to be the only...
No. And then this is just the beginning. This is like the Cisco admission that they basically fudged all their numbers in the late 90s.
Yeah.
Right? And then the fraud came out about WorldCom and Enron, and this is just the first. And John Kenneth Galbraith talked about this, a century ago. It's called the bezel, and the bezel, which is the amount of theft, embezzlement, is always there, right? There are bad people doing bad stuff all the time, and when times are tough, there's less. Because there's less activity and there's more scrutiny, to your point. But as things start to get better, the bezel rises along with it. And it doesn't grow linearly, it grows exponentially. And so at the top, at the really ebullient part, nobody's paying attention because everything's awesome. And the bad people get away with really crazy stuff, which in hindsight, you're like, how did that happen? How did we let that happen? Well, because you weren't paying attention. But that moment that it hits your attention, I always say this, like if you open a newspaper, people are like, what's a newspaper? Well, okay, it's this thing, it was printed and you used to read it. If you open a newspaper and you don't have children, you don't see all the diaper ads. But the moment you have children, you see all those diaper ads. It's like, well, why did they just appear? No, they've been there the whole time. You just don't see them. And so the bezel then shrinks as people say, oh, well, that's a bad person. And oh, and that's a bad. And look, we had the to another Chanos, we had the highest level of non-GAAP accounting adjustments in history a couple years ago. Like, what? GAAP, generally accepted accounting principles, exist for a reason, right? You're not supposed to be able to make up how you want to show things. I mean, I hesitate to pick on Elon because he is so beloved, but the lack of generally accepted accounting principles at Tesla is staggering. And that's not just Tesla. I mean, there are hundreds and hundreds of companies, some way worse, that just completely ignore the fact that there are rules to do accounting and they just ignore them. And there's all kinds of stuff that's been normalized through lobbying, right? Just corruption, like revenue recognition and like, well, wait a second, why should you recognize all the revenue if you haven't actually been paid? That doesn't make any sense to me. But, you know, or my favorite is somehow employee stock option expense is somehow revenue. And I don't even understand how that works, right?
How does that work?
Oh, no, it's cray-cray. I mean, it's like, no, that's actually an expense, but somehow it shows up as a positive. I'm like, no, that's an expense. That is money going out of the company. But, you know, and there's a couple things like that where you just shake your head and say, no, that's not logical. But it will go away.
Yeah, I think it will as well. I want to switch tacks here a little bit and talk about US GDP. So, you know, the big story, you know, coming out this week was that US GDP unexpectedly contracted in Q1 of this year. And if you're, I mean, I know what you're going to say.
Unexpectedly? What?
I know.
We've been talking about this for a long time.
I know. They've got it broken out on this chart by different categories, right? So if you're following along with us on video, consumer spending, business investment, housing, inventories, government spending, net exports. Net exports are kind of the big detractor. And actually, there's a pretty wild chart here, which is, you know, U.S. trade goods. The balance of trade here was pretty wild to me. I guess
trade wars are easy to win. Didn't someone say that a couple of years ago? When that we're supposed to not have any trade deficit anymore because we were going to win the trade war just by, you know, jacking up those tariffs.
I'm with you. I guess I had just assumed, I mean, this isn't like something that I pay a huge amount of attention to, but I guess I had just assumed, you know, that in the post-COVID world, we realized that our supply chains needed to be less efficient, more resilient. You know, we were moving away from relying on countries like China. And it's like, it has been I mean, just look at this chart. I mean, it's crazy how much we're still, the goods imbalance has just continued to soar.
Yeah. And again, this is, and we may have talked about this in the past, but this is the Singapore story. You know, Singapore is this isthmus, and they were convinced that the Japanese were going to come by boat and attack them. So they built these giant guns pointing out at the end of the isthmus that would shoot the boats out of the water so they couldn't be attacked. And the Japanese sailed up and or powered up, I guess it was a power ship, and saw the guns and like, well, we're not doing that. So they parked and they hiked up around and came back down and conquered them from behind because they were all looking the wrong way. So the guns were pointed the wrong way. And this is the same thing is the whole trade war was fighting the last war. It was as if, you know, it was all about us importing cheap goods. Oh, no. The future is about us exporting to the largest consumer class in the history of mankind, right? There's 700 million middle-class people in China, biggest consumer market in the world. And so the idea that we would want to antagonize what could be the biggest source of profits for American companies to send stuff to the emerging middle class in China, which is just ridiculous. And now China's, I think, doing this intentionally, like this whole lockdown nonsense and the kabuki theater about zero COVID, I think is to do exactly this, right? Which is to say, oh, I'm sorry, you still need our stuff, but we're just not going to take any of your stuff right now because we're willing to throttle back our economy. I mean, hard to believe they're actually willing to starve some of their citizens, but crazy. But I think this is all to create this Eastern alliance and to get more and more transactions in renminbi instead of dollars. And there's so many people who, Brent, who we had on, he says, Mark, you're an idiot. China is not ahead of us. They're getting killed. I'm like, well, I don't know. We'll see. This to me looks like we're losing. But
it certainly looks like, I'll tell you what it looks like to me, which is just that the system that's been going on, has not broken yet, right? If anything, it looks like it's accelerating, right? The system being the U.S. is our chief export, right, is not corn or whatever. It is U.S. dollars, right, to other parts of the world. And it seems like that system is not broken. And what's ironic about this as well, right, is that while we are, continue to do things that you would think should weaken the value of the dollar, to Brent's credit, right, the Dixie's at 103 today, right? So the dollar is strength, and I know it's compared to other baskets
and most
of currency.
Of that's just the yen, right? Because the yen has just gotten absolutely obliterated. From 110 to 130 now, and I mean it's crazy. I mean the yen number is absolutely insane. And that is going to be the thing that breaks. And I don't think people are paying attention to it like they should. But, that is the biggest Ponzi in the world. Debt to GDP over 220%. Bank of Japan owns 137% of GDP on their balance sheet. Just think about that for a second. More than 100% of the GDP in debt on the central bank's balance sheet. Well, who buys the debt from the central bank? They are the buyer of last resort. That is their name. So it is going to break, and it's going to break with the yen getting completely annihilated. And some bad stuff's going to happen, but we'll cross that bridge when we get to it.
So the reason I think it's worth highlighting GDP here, so you saw a lot of headlines, right? This was, all over Twitter and mainstream media covered this, as GDP goes down, the stock market reacts positively. Why? And I'm not necessarily convinced that those two things are correlated, those moves. But if I had to attach a reason to why that might be, this is the classic bad news equals good news, right? If there really is, Travis Kling has this great phrase, everything is one trade, and everything is trading on what the Fed and global central banks are going to do and interest rates are going to do, then I think, what slowing GDP means is, it probably means inflation is going to be more transitory than people are accounting for right now. And it means that the Fed eventually is going to have to, in the face of a slowing economy, that gives them more leeway, right, to do what they always do, which is step in and cut interest rates.
I mean, look, we've talked about this, and I actually did a presentation yesterday. We do these around the world presentations on a monthly basis, and yesterday was my big day to talk about this topic, which is there's zero chance. And people say, Mark, you can't say zero. I'm like, yeah, I can. I can say zero. I mean, there's zero chance there'll be 10 rate hikes this year. Zero. And I show this chart that says, the market is absolutely convinced, like with 100% certainty, that there's going to be a 75 basis point rate hike in May. Like, I'll take the under, and I'll take anyone who wants to take the other side. I'll take it, right? I will take the other side. I think I would not be surprised, especially given what just happened with GDP, that they actually back all the way off and say, you know what, we're data dependent, we're taking a pause. Now, I don't think their ego will let them do that. I think they're still going to do 25 basis points. But 75? No, zero chance. No way.
Yeah. Look, we've said this before too. I just do not admire the position that they are in right now. I do not. And it's funny because, right, I'm sure the two of the things that they look at, right, obviously there's a lot, they pay a lot of attention to credit markets in general, which are still looking, there's a huge rout in the bond market, still looking relatively healthy just in terms of spreads and things like that. Indices are still not that far off their all-time highs, right? Even though you have immense pain on these but the names are getting bigger and bigger, right? And Amazon they took a bath yesterday.
Yeah.
Let's just call it what it is. Apple is single-handedly keeping U.S. equity indices alive, right?
And
That's got to be what it is.
Financial engineering. I mean, the fact that people can't do math is unbelievable. I mean, the fact that all they do is borrow money at cheap prices and buy back shares is frightening to me. But that's it. Anyway, the point that is super scary that people really are just not paying attention to. This is 2001 all over again. And 2001 was the bad year. 2000 was not the bad year. 2000 was the beginning, right? March, we rolled over. Julian shut his shop. A bunch of hedge funds went under. Tony Dye went out of business. Anyone who was value basically was shunned, right? If you were a value manager, you were put out of business because it was going to the moon. And then March 24th, market rolled over and started to go down. And then the Fed came and said, no, we'll fix it. We'll save it. And there was this big counter-turn rally, almost back to the peak by September. And then the shit hit the fan. And the market fell 6% for the year, which is not that big a number. And then actually rallied again in January. Again, the Fed came out and said, no, it's all good. Everything's fine. It reminds me of that Kevin Bacon scene in Animal House. Remain calm. And then he's trampled into the concrete. And we actually rallied, I can't remember what it was, like 6 or 8% through February, and then bang. Then Cisco and all the fraud came out. WorldCom turned out to be a total fraud. Enron, and it was bad. And to your point, it was the credit markets. The credit markets exploded. And I'll give you an example of why people should be afraid. HYG is down double digits now. That's the high yield ETF. And there are a number of credits that are down significantly more than that. And the one that I will now call this one of the events that we'll look back on. And I think Archegos and Bill is certainly one, but Carvana, what Carvana did the other day is,
I also saw this.
No, this is crazy stuff. So Apollo, right? Now, remember, Apollo is headed by a guy who's kind of part of the cabal. So he kind of gets special treatment and special stuff. And so they basically put debt into rescue finance into Carvana with special rights in the event of bankruptcy. Well, who said anything about bankruptcy? This stock is going to zero. I mean, there's no question in my mind that the equity is going to be extinguished, and Leon et al. Are going to own this company, and it'll probably be a great investment for them long term. But man, if you are long that stock, get out. And there's a whole bunch of these, like Affirm and others, even Shopify. These hedge fund hotels, they're down a lot, and people say, oh, they can't go down anymore. Oh, no, yes, they can.
They can. This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto-native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking, Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. Yeah, I wanted to get your thoughts on this. I saw this great thread from Chris Berninski, he's one of these guys in crypto. Every time I listen to that guy talk, I'm like, yeah, I agree with that. That feels like a rational opinion. He's great. He kind of compared, the pain that we've seen in crypto thus far to, some of these darling tech stocks. And honestly, the pain that we're seeing in the darling tech stocks is worse than the pain that we've seen in crypto, right? Crypto's 100%. Down about 40% from its all-time highs. Some of these like pandemic darlings are down. If you look at, to take a couple, Robinhood, Peloton, Zoom, Teladoc, we've been talking about these. The percentage that they're off, it's like 79%, 82%, 86%, 88%.
Teladoc was down 49% yesterday in one day.
I know.
And that's the thing. Remember math. You know what the difference between down 90 and down 95% is? You lost half your money. That's a 50% drop to go from down 90 to down 95. And that's what's happening to these companies. Yeah, I put up a chart of, I've been on Peloton and Zoom for a long time, and they are the worst charts. Like if you pulled up a chart and said, I want to show you an ugly chart, like a chart that no one would ever touch. This is it, right? A declining 200-day moving average, a declining 50-day moving average, a declining 20-day moving average. The price below all three of those on rising volume. You would run away, and yet there are still people who are like, oh, this is a value. I mean, this is crazy. And I have respect for Cathie Wood. I'm not a hater, right? I don't own the anti-ARK ETF. She's had in ARK, ARKK, net positive inflows this year, despite the fact that ETF is down 69% year to date, because people think they can catch the falling knife and that these stocks can only go up. And Teladoc is a perfect example. She bought Teladoc 2 days ago, right before the earnings announcement, and it went down 49% overnight. Hopium is not an investment strategy. Hope is a 4-letter word in the investment business, hoping that somehow these things are going to go back up because they were high before. We are in the bear market. We are in the tech wreck 2.0.
I agree, and it feels like that in crypto as well. Like this is a bear market, and I like what we've been saying too. I actually do believe. I believe that this bear market is not going to be as bad as previous bear markets that we've seen in crypto, but that doesn't mean it's not a bear. And from what I've seen, purely sentiment wise, and like other factors, I don't think that we've reached the bottom yet. I would say I just don't.
Well, look, but before, when winter would come, we had, the Fed with their Elon flamethrower out there melting the snow as it was falling down, and it was just fine, just like a light mist. That's gone. They don't have the ability to turn on the flamethrower because their gun is out of ammunition, and they should have reloaded. In 2013 when they had the chance, but they didn't. And now they're stuck in a place where now they can't raise rates. Just no chance they can raise rates because we are probably in recession already. We are in winter for financial markets. And here's the thing that I am nervous about. People say, well, how bad can it get? I'm like, well, we've talked about it. Like the fair value, we had Tim on the show, right? The fair value of Bitcoin, we use Bitcoin as a proxy for everything. The fair value, it's 33, 34, 35K, whatever the number is. Okay. But the problem is you can go below fair value. That happens all the time. So how bad could it get? Well, really hard for me to see going much below 30 because there's not a lot of people who bought at that time where we were running from 20 to 40. So just that seems like a pretty fair place to have a pause from selling pressure. But the problem is if things get really ugly, right? If more companies miss earnings badly, like Netflix and Amazon and others, and we still have the highest margin debt ever. And if margin debt leads to margin calls, people will be forced to sell gold, bonds, and Bitcoin. And that's the time when I get a little bit nervous. Now, long term, I like it because then I just get to buy more at a cheaper price. But in the short run, if you're levered in the crypto markets right now, I might take some of that off.
Well, you definitely just don't want to be a forced seller in situations like this, right? That's the worst thing that you can be. But I also think, especially when it comes to crypto is a very reflexive space, and people don't have their valuation models yet. Where when the PE ratio gets too out of whack, Warren Buffett comes in and buys it up because it's on the cheap. I mean, there's a lot of relative valuation that goes on in crypto, right? Valuing Solana relative to ETH. You hear, well, ETH is worth X hundred billion, Solana's only worth 32 or whatever it is, like, therefore, and those relative valuations serve you very well on the way up, but they get you in trouble on the way down too. I'm actually not super bearish though. Because here's the other thing, the one thing that might be different a little bit for crypto this time is the raw amount of capital that's looking for a home in the space.
Definitely.
And honestly,
Definitely.
There is still a tremendous amount of money looking for a home that has not, in the form of funds, in the form of whatever, that has not been deployed into the space yet.
That's 100% true, Michael. And the challenge though is that might get delayed in the sense that if you're suddenly forced to cover margin calls in your other parts of your portfolio, and institutions in particular, we actually, I shall remain nameless, but I have an investor that has made a lot of commitments, to good firms, and but some stuff has happened in the public markets that have gone down a lot, and so they now are looking to sell a piece of an illiquid asset to try to make ends meet. Please don't sell that. Right? Because you're going to take a big hickey at the wrong time. And I think there are a bunch of institutions that would love to add here or even get off zero, right? I told you 83%. I talked to 120 pension funds a couple of weeks ago. 83% of them have zero. That is bad news and good news. It's like great news, actually. It means we're still so early.
I haven't heard this theory anywhere, but I'd be curious. Maybe one of the reasons why crypto is holding up relatively well, in my opinion, compared to some of these growthier tech stocks, is maybe investors that were worried about turbulence in the public markets, they did some of the selling that they were going to do already. This always happens, right? In these bull markets, people FOMO in, like weak hands, big Web 2 VCs and big, macro funds that don't have a strong conviction or thesis in the space, but want to get some of the returns. They buy in, and then at the first sign of trouble, they kind of sell off, right? So I wonder if some of the selling has already occurred for crypto, and that's why it's holding up relatively better than some of the stuff you see happening in.
I think that's a really good insight, and I think it's probably right. And look, the only risk that I see is this margin call forced selling risk.
Yeah.
And I said, if you are watching this and you have leverage in your crypto portfolio, take it down, right? And not to zero, but it's like, how much leverage would you put on your house? Would you put an 80% mortgage on your house? Sure. 4-to-1 leverage? No problem. Would you put 90? Ooh, 10-to-1? I don't know. Would you put, 3% down? 97% mortgage? Less good. Now, the nice thing is in the housing market, you're not normally forced to sell, right? Even if your house goes down 10%, the bank doesn't call you up and say, you're underwater, you need to pay off your debt. In the equity market or the crypto market, that prime broker is going to call you up and say, I need more money or I'm seizing your stuff. So I do think just people need to be cautious. But I'm still of the view, and we've been talking about this for a while, and I've been wearing my cold storage, crypto winter dual function socks for a while, that this is going to last for a while, right? We're 9 months away from spring, and winter is a cleansing time. And there's some stuff that needs to be cleansed. There's some bad projects out there. There's some hucksters out there. Not many. That's the thing. That's the thing that's cool is for all the nonsense of people saying, oh, it's all scammers. It's not all scammers. There are certainly scammers, but there's scammers in stocks and there's scammers in bonds and there's, scammers in everything. But the vast majority of the people in this space are really good people, really smart people, really motivated people, really, I just get energized every single day that I interact with the people in this space.
Yeah. I mean, look, the whole, we've talked about this before, but I feel like one common thread of crypto and probably just business cycles in general is ideas get tested, something kind of works into the bull run. And then, when everything rolls over, we're like, ooh, there was something there, but maybe we need to rethink a little bit of it.
Yep.
One thing that people are rethinking right now is just yield farming in general. You saw Compound this almost passed. They kind of kicked everything. They were some of the original pioneers of yield farming in general, but now there are all these problems with bringing mercenary liquidity, and for the expense, the cost of acquiring those customers, we're getting kind of shit customers. So how do we think about longer term incentivization? There's like a lot of interesting innovation going on. I want to get your take on two more stories. Here is one that if this was a bull market, this would have been this gigantic story and everyone would have been talking about it and diamondized to the moon. Fidelity has now integrated into their 401k plans the ability to include Bitcoin. That is just a monster story that didn't get as much attention as I feel like it deserved. And already you kind of have, you've got the Labor Department, saying they have grave concerns over the 401k plan for Bitcoin. And, there are these quotes, and the Labor Department they're responsible for regulating those 401k plans for Americans. And they cite market volatility and all
concerns.
that
stuff. Of course they have grave concerns because the CEO of Bitcoin was unavailable to contribute to their super PAC, whereas the CEO of BlackRock and Vanguard has contributed a shit ton of money to their super PAC. And actually, this is just crazy. The CEOs, I don't know if it's CEOs, but someone in those two organizations actually sits on the committee that drafts the laws. I mean, that is absolutely insane. I mean, complete insanity. And so, of course, the ETF and mutual fund businesses do not want you to transfer your money out of their beloved ETFs and mutual funds into Bitcoin. Look, the 401k was created in the Tax Act of 1986, which had nothing to do with taxes. It had everything to do with shifting from defined benefit to defined contribution. It saved companies 35% straight to their bottom line into the the management's pockets, and the average person got screwed. They used to have a pension where you actually got a benefit. Now, most people have no idea how to manage money. And that's not a criticism of them. They are good nurses and good doctors and good lawyers and good business people. They're not investment people. They used to have professionals managing their pension. Now we're supposed to do it ourselves, and we're given 7 choices: stocks and bonds, no hedge funds, no private, no alternatives, no diversifiers. It's just a transfer of wealth from the working class to the elite class. And this is a horrible, horrific example of how ridiculous it is. One of the true leading lights of the industry, Fidelity, is saying, you know what? This is real, and this is important, and this is a true diversifying asset that can add value and protect people. And then you got a government agency that is paid by the people sucking fees out of the people's wallets, saying no. It's like the banking response, the banking regulator response to people who pay people to convert from fiat into digital assets and deposit it and get paid interest. What's wrong with that? Oh, well, what's wrong with it is the money's coming out of the banks. So the banks pay the regulators to overregulate. Insanity.
Yeah.
I feel really strongly about this one, by the way.
I can't tell. I agree with you. I also, it's just made me think. I've been having more conversations with people. And one of the other things that makes me pretty convinced there's a bear market is because the last 18 months when crypto was the new sexy thing again, everyone's like, oh, suddenly Blockworks seems like a really good idea. Crypto's really interesting. Oh, I didn't understand it before. Now I get it. And now when I have conversations with my friends outside of the space, it's like, okay, it's a scam again, isn't it?
Right.
And
exactly.
that idea always unwinds, right? When the price moves the other direction.
Yep.
And this culminated. I had this conversation with this guy who works in finance the other day, and I don't know. I think part of this too is that so many people. This is one of the most difficult things about trying to educate someone on crypto in general. Everyone says, well, if I can't understand it in 5 minutes, then well, just explain it to me like I'm a 5-year-old. Like they want that like 30-second explanation that's just going to make it all click. And after 4 years of this space, I just don't think it exists. I think you need to invest a certain amount of time to understand it yourself. Yeah. And that's too bad. That's not going to work for everyone. Eventually people stop questioning things.
People spend more time playing Candy Crush than investigating how they should invest their capital.
Right.
Full stop.
So, when I see stuff like this, I know there's still an enormous amount of mistrust at an institutional level. Some of it probably is there are misaligned incentives, right, in how the current system works. But the reality is it's unrealistic to ask. It's unrealistic, whatever. It just doesn't happen. People in places about, they just aren't going to put the time in to learn, because why would they? So I don't know, but it's a huge story, right? So
this too shall pass, though.
This too shall pass. Well, look,
people are going to be forced out of necessity to catch up, just like they were. Look, there was a time in this country where people had bonds in their retirement account. That's it. No equities, no international equities, no nothing, just bonds. And there was actually a cover story in 1981 on Time magazine, the death of equities. Quote, no self-respecting fiduciary should ever own equities again. That might have been the best time ever to buy equities after the previous 13-year bear market from 68 to 81. But that's the way the world works. So people will do the work and they will get educated. And many have, right? There are lots of people who have done the work, look, myself included. I was a skeptic at the beginning, and it actually took me too long, right? It took me years. It should have taken me weeks or months, but it took me years to actually find the time. But I didn't find the time. I made the time. It's like exercise. You don't find time to exercise. You make time to exercise. You don't find time to do research. You make time to do research.
I have a question for you. What was the? I have a theory that there are two types of people who enter crypto at the beginning of bull markets and the end of bull markets. And Jason and I entered at the end of a bull market.
Yeah.
And I think it just cost us like 2 years of really buying in and fully because by the time I committed to this space and was like, I just watched it go down for 2 years and all of these ideas get decimated. And I think it made me a little bit more skeptical than some of my friends who got in at the beginning of a bull. They just got in and then just watched everything work for 2 years.
You're going to laugh is you're right? It depends when you get in, but then your reaction depends on your zodiac sign.
All right, I'm a Capricorn. What does that mean?
Now that's weird because you, like me, I'm a bull, right? My birthday is coming up. You should have been like me because my wife's a Capricorn and my son's a Capricorn. And it's like bullheaded, right? I mean, just the ram and Aries and Capricorn's the goat, and that stubbornness of when you're in a bear, if you come in at the top and you're in a bear market and everyone's telling you how freaking stupid you are. I mean, I took immeasurable shit in 2018 and 19 from people on Twitter. You said this was great. You said this was awesome at 10,000 and now it's 3,000 and you're a freaking idiot and you cost me so much money. One of the best days, I won't say of my life, but one of the best days of the past couple of years is I woke up and I had this notification on Twitter from Mark Cohodes, who I have incredible respect for.
Love Mark.
One of the great investors of all time. And he's like, Yusko, I love this guy. He was so convicted and so right. And y'all need to wake up and give him credit. I'm like, damn, thank you. I mean, that meant a lot to me because, it was hard.
Yeah, you stuck through it.
When you're being told you're an idiot. But I'm a bull. So the more you tell me I'm an idiot, the more right I think I am. Which is interesting.
We call that a double down.
Right.
Double down is a classic strategy of Mike Ippolito. I will tell you that.
Yeah. It's when I was applying to colleges, I picked the schools and I told my dad, and one of them was Notre Dame. He says, "Oh, why would you apply there? You'd never get in." I'm like, what? He did intentionally because he knew that would make me get in. And sure enough, I called him out on it one time. I said, "Did you really have that little faith in me?" "No, Mark, I knew exactly how to make you work harder." I'm like, "Oh, damn it. It was manipulated."
Yeah.
So,
in a good way, though, for positive reasons.
For love and in a good way. But it was just so, he said it so matter-of-factly. "Oh, you'd never get in there."
That's really funny. All right, Mark. Well, that's unfortunately all the time that we have this week.
All right,
but this was a lot of fun, as always. And I will see you same time next week. Cheers.
Have a good one.